Europe's energy crisis explodes. How Middle East tensions could trigger a global economic shock. Right now, while the world watches missiles in the Middle East and drones crossing skies, something far bigger may be unfolding, not on the battlefield, but in the global economy. Flights are being canceled, markets are trembling, energy traders are panicking, European leaders are scrambling behind closed doors. And here's the question no one is asking loudly enough. What happens if this war doesn't just stay regional? What happens if it triggers an economic chain reaction that hits Europe first and then the world? Because within days of escalating tensions, natural gas prices in Europe surged sharply. And when energy prices spike in Europe, everything changes. This isn't just about war. This is about economic survival. To understand what's happening, we need to understand one simple reality. Europe runs on natural gas. Gas heats homes in winter. It powers factories. It generates electricity. It fuels heavy industries, chemicals, steel, fertilizer production. Now rewind to 2022. When the Russia-Ukraine war began, Europe dramatically reduced its dependence on Russian pipeline gas. That was a political and strategic decision. But energy doesn't disappear just because you make a political choice. Europe had to replace that supply, fast. And where did much of that replacement come from? Liquefied natural gas, LNG, shipped from countries like Qatar and the United States. That means Europe became heavily dependent on global LNG markets, markets that are extremely sensitive to instability. So when tensions rise in the Middle East, especially near major LNG infrastructure, energy traders react immediately. Prices spike not just because of actual supply disruption, but because of fear, and fear moves markets faster than facts. Let's break down what a sudden spike in gas prices actually does. Imagine you run a factory in Germany. Your energy bill doubles or spikes sharply within days. You now face two choices: raise prices on your products or reduce production. If you raise prices, you lose competitiveness, especially against manufacturers in China, where energy costs may be lower. If you reduce production, workers lose hours or jobs. Now multiply that across chemical plants, steel producers, fertilizer manufacturers, food processing facilities, transportation companies. The impact spreads fast. Energy to manufacturing, to supply chains, to food prices, to inflation, to consumer spending, to economic growth. And here's the real danger. Europe is still recovering from the last energy shock triggered by the Russia-Ukraine conflict. Inflation had already surged, interest rates had already been raised, households were already strained. Another energy spike could reopen wounds that never fully healed. Financial markets under pressure. Now let's talk about something most people don't see but feel later: financial markets. Because before grocery prices rise, before layoffs begin, before headlines scream recession, markets move first, and they move fast. When energy instability hits Europe, traders don't wait for confirmation, they react to risk. This is how modern finance works. It's not just about what is happening, it's about what investors think might happen next. Step 1. Currency pressure. When energy prices surge, Europe faces a serious problem. It imports a large portion of its energy, and energy is priced globally in US dollars. So if gas prices surge sharply, European countries must spend more dollars to secure supply. That increases demand for dollars, and when demand for dollars rises, the dollar strengthens. When the dollar strengthens, the euro and British pound often weaken. Now here's why that matters. A weaker euro makes imports more expensive. Energy becomes even more costly. Inflation rises further. It becomes a feedback loop. Currency weakness to higher import costs, to higher inflation, to economic stress. Step 2. Stock market shockwaves. Investors hate uncertainty more than anything. war uncertainty, energy uncertainty, supply chain uncertainty. When uncertainty spikes, institutional investors, pension funds, hedge funds, global banks begin reducing exposure to riskier assets. European stocks often get hit first. Why? Because higher energy prices directly impact corporate profit margins. If you're an investor holding shares in a German chemical company or a French industrial manufacturer, and you see gas prices jumping 30%, 40%, even 50% in a short period, you start asking, how much will this hurt earnings next quarter? If profit expectations fall, stock prices fall. And when stock markets drop, consumer confidence follows. People spend less, businesses delay investments, growth slows. Step 3. Bond markets and interest rates. Now let's go one layer deeper into the bond market. If inflation rises again because of energy shocks, the European Central Bank faces a nightmare scenario. Do they raise interest rates again to fight inflation? If they do, borrowing costs rise, mortgage payments increase, business loans become more expensive, economic slowdown accelerates. If they don't, inflation remains elevated, currency weakens further, purchasing power declines. It's a lose-lose balancing act, and bond investors know this, so government borrowing costs can increase during instability. That adds more fiscal pressure on already stretched European economies. Step 4. Flight to safety. During global instability, capital doesn't disappear, it relocates. Historically, money flows towards U.S. treasuries, the U.S. dollar, gold, sometimes oil commodities. This is known as a flight to safety, and when that happens, it creates divergence. The U.S. financial system often strengthens, European markets face capital outflows, emerging markets struggle even more. It's not personal, it's structural. The U.S. dollar remains the world's reserve currency, and in times of crisis, global capital seeks shelter. Step 5. The psychological multiplier. Here's something even more important. Markets are psychological. If investors begin believing that Europe is heading into another prolonged energy crisis, even before it fully materializes, behavior changes immediately. Companies freeze hiring, executives delay expansion, banks tighten lending standards, consumers postpone large purchases. Fear becomes self-fulfilling. That's how financial stress transforms into economic slowdown. Not because of one event, but because of accumulated anxiety. Why Americans should care? Now you might be thinking, okay, but this is Europe. Why does it matter to us? Because the global economy is interconnected. American companies operate heavily in Europe. European banks are intertwined with U.S. financial institutions. Energy price spikes affect global oil markets, which affect U.S. gas prices. If European demand slows dramatically, global trade slows. If European banks tighten liquidity, financial ripple effects cross the Atlantic. The U.S. doesn't operate in isolation. No major economy does. The big picture? So when you hear gas prices surged in Europe, it's not just about heating bills in Berlin. It's about currency markets shifting, stock markets adjusting, bond yields reacting, investors reallocating trillions of dollars, and central banks being forced into impossible decisions. Financial markets are like pressure gauges, and right now, that gauge is rising. The question isn't whether markets can handle volatility. They can. The real question is, how long can this pressure last before something cracks? Now let's shift from energy to military economics, because this is where modern warfare changes the equation. Traditional warfare used to revolve around tanks, jets, and large-scale invasions. Now, drones, missiles, precision strikes. Here's the strategic imbalance. A relatively low-cost drone can be deployed for tens of thousands of dollars. To To intercept it, you may need a defensive missile that costs hundreds of thousands, sometimes millions, per launch. Think about that. If one side can produce thousands of drones at low cost, and the other side must spend exponentially more to intercept each one, the financial pressure becomes enormous over time. This isn't just about battlefield damage, it's about economic endurance. Prolonged, low-cost drone warfare drains high-cost defense systems. And if conflicts expand regionally, protecting infrastructure becomes extremely expensive. Air bases, oil facilities, shipping routes, energy terminals. Every layer of protection adds cost. And costs eventually hit taxpayers and economies. Europe now faces uncomfortable choices. Option 1, double down on its current energy strategy, rely on LNG imports, maintain sanctions, and hope markets stabilize. Option 2, quietly reopen energy channels with Russia. Option 3, accelerate renewable energy transition, but that takes years, not months. Option 4, deepen reliance on U.S. energy exports, which ties Europe even more closely to American policy decisions. But here's the reality. Energy security equals national security. And when homes can't be heated, when factories shut down, when food prices rise, public pressure builds fast. History shows us that energy crises can trigger political instability. We've seen it before. Now step back and look at the bigger picture. We have ongoing war in Ukraine, escalating tensions involving Iran, Israel deeply engaged in security operations, the United States balancing global commitments, China watching closely, Russia entrenched in a long-term confrontation with the West. These crises are interconnected through energy, trade, and finance. The global system is tightly woven. If Middle East instability pushes oil and gas prices higher for months, not days, the ripple effects could spread worldwide. Emerging markets suffer, shipping costs rise, airlines struggle, insurance premiums increase, global inflation pressures return. This is how regional conflicts become global economic stress events. Final reflection. Are we witnessing the start of economic collapse? No, but we are witnessing fragility. The global economy today is deeply interconnected and highly sensitive to energy disruptions. Europe is particularly exposed because of its post-2022 energy restructuring. If tensions ease, markets stabilize. If tensions escalate, pressure intensifies. The next few months will determine whether this becomes a short-term shock or the beginning of a deeper global economic realignment. And the biggest question remains. In a world where energy is weaponized, alliances are shifting, and warfare is cheaper but more persistent, who adapts fastest? Because in this new era, resilience may matter more than strength.